Hi, and welcome to the Approved Guy channel. I'm Sebastien Boyer, the Approved Guy, and on today's video, we have a special guest. Miss Denise Clemence, the SBA Queen, is back with us for a special visit, and we have lots to talk about, lots of updates. Let's jump right to it. Hello, Denise. How are you today?
Good afternoon, Sebastian. Thank you again for having me. It's so good to see you.
As well, me as well. Thank you so much for joining us and honoring us with your time and your knowledge, wisdom, and presence. So D, there's lots of new things going on. We have a little bit of a shift in the rates, right? The prime rate just changed a little bit, and it's been a while. So I want to kind of just kind of go through a little Q&A as if I was someone for the first time, just thinking about an SBA, and I don't know much about this, and let's see if we can help those people out, and we'll take it from there.
Sounds
So,
good.
so I guess the first question I have is, what's the interest rate on an SBA loan right now?
Well, it depends on the loan product. So primarily we usually spend most of our time on the SBA 7A loan because the 7A loan can be used for all types of services, all types of uses for a small business, everything from commercial real estate, startup, franchise fee, working capital, construction, furniture and fixtures, equipment, etc. So on the SBA 7A loan program, the maximum interest rate is derived by the United States government through the standard operating procedure book. The current book that we're working on was approved November of 2023. So on a loan over $500,000, the maximum interest rate is Wall Street Journal Prime plus 3%. The spread is the 3%, which is negotiated with the lender. And that's typically negotiated based on the strength of the deal. So the one constant that we always have, of course, is going to be Wall Street Journal Prime. The current prime rate is 8%, which fell a half a point in the month of, was it September?
Mm-hmm.
In the month of September. So at the maximum interest rate on a loan, 500,000 and above, it would be Wall Street Journal Prime plus 3, which is 8 plus 3, which is 11.
11. Okay. And that's a 10-year term, correct?
Well, it could be a 10-year term if it does not include commercial real estate. If it includes commercial real estate and the commercial real estate is the majority of the loan, then it would be termed out over 25 years.
Oh, wow. So it could be termed out over 25 years. Now, is there a situation where could be a kind of like a blend between a 7A and a 504, or are they always completely separate? How does that work?
So if you've got a loan where, let's say, 40% of the loan is commercial real estate, which is amortized over 25 years, and 60% of the loan would be a 10-year term, meaning it's for furniture and fixtures, equipment, working capital, then they would blend those rates based on the proportion of the what's being financed.
Okay. Okay. So I'm an existing business. I've been in business for only a year, right? Am I still a startup, or am I considered an existing? Do I have to wait 2 years to show tax returns, or where am I? Where do I fall in the eyes of the bank or SBA?
Under the definition of the United States Small Business Administration, anybody that does not have 2 years of tax returns, being in business for 24 months, they still define it as a startup business. It
Okay.
does not mean you can't obtain a loan. It just means that you are defined as a startup business.
Okay. And will the banks and does the SBA help fund startups?
SBA does fund startups. It just depends on what the use of funds is for and the lender that's looking at the loan as to whether or not that's within their credit appetite. But I have done multiple startup franchise loans, startup assisted living center, startup daycare. You can do a lot of different startups. The problem with getting a loan after only being in business 1 year is, did the question that the lender asks is, did the business not prepare itself and get the loan ahead of time, or is this a growth mode? And the only thing that can answer that question would be the tax returns and the financials to see how the business is running and are they on trajectory to be able to repay the debt. Because remember, the reason we lend the money is because you can repay the debt.
Certainly. So now, would it be more advantageous or beneficial to me as a startup to seek that loan out before I launch, a year earlier or a year later? Because I think a lot of folks think that they should wait until they actually open their doors and start the business, and that's I think maybe I'll let you answer the question. Like, what would be a better, wiser approach? Waiting or beforehand?
The wisest approach is to come to a lender with a full package, meaning your business plan, your projections with assumptions showing what your business model is, how it's going to succeed, and having a very detailed list of exactly how much money you're going to need in order to reach the success.
Hmm.
That way, we're starting in the very beginning, knowing that you have the access to capital and the appropriate money in order to reach your success. If you start your journey and you run out of money in the middle of the first year, it's hard for us to go backwards and look at what should have happened and didn't happen. So at that juncture, most lenders push back a lot because they really want to see that the business at that juncture can survive and pay the debt. Um,
So
I
you,
hate to use the PPP, piss poor planning, but
mhm.
lenders really want to see that it was planned appropriate, that all the information was, concisely delivered in a business plan and projections in order to fund the startup from day one.
So you said that twice now, business plan and projection. So how important is the business plan and projections, and what exactly is it that you're looking for in that business plan that helps the bank and helps you feel good about the particular project?
Right. So a business plan is required by the SBA as well as the lender, along with projections for any startup, for a business acquisition, which is also considered a startup, or for a business expansion, meaning they're expecting like trajectory growth. So the business plan is obviously very important, and the SBA has identified some clear items that need to be in the business plan, including market conditions, what sets this business aside from its competitors. We don't like to see anybody say, we don't have competitors.
Mm.
Everybody has a competitor. Um, who the management team is, what's their experience, um, what's the plan moving forward. Everything needs to be pretty clear laid out so that we understand in as a lender myself and the underwriter understand and can cohesively figure out how this business is going to fit into the marketplace. So that also includes demographics, opening a daycare in Fort Lauderdale versus Tampa. What community are you in? How many households are there? Where are your clients coming from? Whether it's a daycare or a restaurant or a manufacturing company, where are you selling to? What's your markup? What's your margin? What's your day turn on product and selling products? There's so many different aspects that could go into the plan
Hmm.
depending on what industry you're in.
And then ultimately, all of that is going to speak to the projections, and you want to see 3 years projections, and the first year needs to be broken down monthly. Is that correct?
We prefer 2 years of projections.
Okay.
And on startups and business acquisitions, we prefer to have 2 years monthly with assumptions. And the assumptions where everybody forgets, what is an assumption? What is an assumption? So on a startup, it's very common that sometimes I'll see that somebody starts it. I'm just pulling out a number. They're going to start at $500,000 revenue for the first month.
Yeah.
But then month 12, they're doing 500,000. Nobody starts up a business and reaches their maximum monthly goal. So in the projections, we want to see a normal ramp up time. That's also a time where we're going to be able to identify any seasonality in the business. If you're a daycare, obviously your normal year would be August to June, and then you go into summer months and you might offer summer programs. If you're a gym, we all know that gyms have a um, heightened membership through the holidays and then drops off a little bit. So we're looking at that's why we want monthly is for those assumptions for the seasonality.
Hmm.
and what happens through that. And then the assumptions explain how the numbers go. Are you, are you raising your revenue by 5% a month? Or why is membership in a doggy daycare higher during Thanksgiving and Christmas versus summer? It's holidays and people are going on holidays. So that's where the assumptions come through as to explain what each line item is and how it's going to react to the market or is expected to react to the market during its operation.
So I need to take my time and do my diligence, know my market, know my business, know my numbers, and be able to explain that if I want to get a loan.
Yes.
Yes.
We do, as lenders, take the business plan and the projections very seriously. I've seen on many podcasts, oh, nobody really looks at it. We look at it, we read it, we redline it. That is the deal. When you look at an SBA loan, the majority of us are cash flow lenders. Well, if you're a startup, the only cash flow I have is the projections,
Mm,
which is where it comes in. When you're doing a franchise loan, you're going to do those projections based on the franchise disclosure document. And
hmm.
if they're out of line with the franchise disclosure document, it needs to be explained why. Like
Yeah.
if you're projecting 20% greater, well, how are you getting there? If you're doing a business acquisition, we're going to compare your projections to the seller's financials. And if you've got a huge difference, then you have to explain, why is there a difference? How did you come up with those numbers so that we can, validate that what we're seeing and what we're approving is true and correct?
Okay. Awesome. So, speaking along these lines and, being able to, looking at cash flow and you're looking to see that the client can service the debt, right? So that leads us to debt service coverage ratio, which is, I know, something you're looking for. Can you talk to us a little bit about debt service coverage ratio, or DSCR is the acronym, if you would
Yes.
elaborate a little bit on that?
So what we do is we look at the EBITDA and see whether or not it can service the debt. EBITDA is earnings before interest, depreciation, and amortization. So when you look at the net profit of the business, we're going to take that, we're going to add back any interest expense, which again, we're going to go back to those projections. If you're making projections, you have to project the interest expense every month because you will be paying interest. We will add back interest, depreciation on equipment and or real estate in the amortization, which is amortization is depreciation of a business acquisition. So you depreciate real estate, you depreciate equipment, you amortize goodwill. Um, so when you add those back, we want to balance out and make sure that you can pay your payment and still make a positive profit. And
Perfect.
that's what we're looking for to approve a loan. And the SBA has what they call a global DSCR. The
Okay.
global DSCR is a 1.15. What that means by global is that the business debt service coverage is one thing. When you look at it globally, then what you're doing is you're taking into account the required salary for the owner to pay his personal debts. So that all depends on the borrower. Some borrowers must have $75,000 a year to make their house payments, their car payments, and all their stuff. Other people only might need $35,000 because they don't live as large, or they may have paid off their home, whatever it might
Yeah.
be. So globally, we're going to take into account the owner's salary as well and making sure. So that goes to when you're doing your projections, you always want to make an owner's salary line item there. Just don't put manager or clump all your salaries. We need to see as lenders, how much are you expecting to pay yourself? And
Well,
is that
Denise,
adequate?
this is a business loan for my business. Why are you basing your assessment on me personally? I'm looking for a loan for my business, not for me. This is the kind of question, that I've heard people push back on.
That you get.
Yeah.
And it's fully understandable, but aren't you going to pay yourself? And if you have debts, how are you going to pay your debt if you're not getting that money from the company?
Of course.
So we have to look at the whole global. If you go out on internet anywhere, it's pretty much a statistic that when a business starts suffering, and a personal starts suffering, an individual will pay their personal bills before they pay their business bills.
Mhm.
So therefore, as a lender, it is prudent for us to make sure that you can pay your personal bills out of the projections you provided.
So we're still talking about a startup, and we'll talk a little bit more about an existing, business a little more later. But now, if I'm a startup and I'm coming in, that means that you definitely are going to be looking at my personal finances, closely, because the business hasn't even started generating revenue. So the only thing you have to go off of are two things: my projections, right, and the debt service coverage ratio based on those projections and how well I presented my case, and my personal income and personal financial statement. So what kind of things like should I not do? Like, if I'm employed, should I keep my job? And if I don't keep my job, what are you looking for in terms of income, cash flow, reserves, and deposit requirements for, I know there's more or less two or three startup scenarios. There's your pure mom and pop startup. There's your business acquisition startup. There's your franchise startup. I think those are like the top three, more or less, right? So in those three scenarios, if we could talk about that a little bit, what should I be prepared for? Deposit, reserves, if I'm employed, if I'm not employed, what are we looking at here?
So let's tackle them each a little bit separate.
Okay.
So deposit relationship depends on the lender in which you choose. I work for non-bank lenders. The institution in which I work for, we don't take deposit relationships. We are strictly an SBA lender. It's all we do all day long. If you decided to take your loan to a normal traditional community bank or a credit union, they may require you to put deposit relationships into their bank in order to supply you with a loan. That's up to every borrower. Then you talked about reserves. So the SBA has a regulation in their book, which they strongly suggest that a borrower should have their equity injection in cash and then what they call post-closing liquidity. That's money left in the bank after your down payment equity injection. And pretty much everybody sticks to the 6-month rule. So 6 months of payments should be left in your bank after you make your down payment in order to cover any cost overruns or any hiccups in your plan from, to going to profitability.
Yes.
So if you've got a very large deal, some lenders may require more like a year, because if your projections are showing that you're not actually cash flowing for an entire year, we want to make sure you can pay the payments for a year.
Yes.
So therefore, the post-closing equity injection would increase. And then on the personal side, there's so many different factors on the personal debt to income ratio. You've got, if you have an outside job, if you're keeping it, how are you going to manage running the business? You could get caught up. A lot of individuals have a spouse that might have an outside income, which of course is strength. We would take that into account. So let's say you need to make $75,000 a year to make all of your payments at to meet your personal debt to income ratio. Let's say your spouse might have a job making 50,000. Therefore, you only need to take the additional 25,000. So that can come into play as well. Pension plans, there's so many different disability. You might have military pension or disability coming in, something like that. It's all taken into account in the calculation. My biggest recommendation is don't drive up your credit, get rid of your credit cards, keep your debt requirements low, because the last thing you want to do is take on a $500,000 business loan while you've got $80,000 in credit card debt.
So
So
quick
keep
question on that
personal.
before we go. So you said get rid of my credit cards. Are you saying get rid of the actual balances, the actual debt, or actually close the cards?
Lower your balances.
Lower
I
the balance.
can't
Okay, just want to be clear on
you're
that.
not dictating
She's not
to
saying to
your
cancel your credit cards, folks. She's just
Yep.
saying keep your balances down, and come in with low utilization on your credit. And Dee, I have to say thank you, because I asked a question and I used the word deposit, but I meant to say equity injection. And I'm glad that I asked that, because you clarified that potentially with your FDIC depository banks, they may require a deposit into their bank. They may then require an equity injection, right? Which is a down payment, separate item, and post-closing liquidity. Where if it's not an FDIC insured depository bank, But if it's a preferred SBA lender, non-bank, then potentially there is no deposit requirement. You're still going to have the equity injection, down payment requirement, and post-closing liquidity. So can we talk about the equity injection, down payment requirement in a circumstance of a franchise, a business acquisition versus a pure startup? Is it always going to be the same? And what are the potential ranges that we'd be looking at?
So like we said, the SBA SOP set your minimum guidelines. The minimum guidelines by definition of the SBA is that on a 7A is a minimum 10% equity injection, whether it's a startup, a business acquisition, whichever way, it's a minimum of 10%. A lender has the ability to require a larger equity injection. So if, for instance, I'm working on a gym, the gentleman already owns a gym. He's owned 5 gyms in his life. So he sold them, bought another one, sold them. He has one. He's going to do another one. We would accept a 10% equity injection and possibly even something smaller, depending on the strength of the existing gym. If it's just a mom and pop startup of a gym and there is no definite experience or franchise behind it, some lenders may require 20 or even 30% because there's no strength to say that they're actually going to be very successful.
Mm-hmm.
So that's when a lot of individuals look at, okay, we'll go to Gold's Gym. Well, Gold's Gym has been around a long time, or Planet Fitness, and they're an A-rated franchise. Then you go back to, okay, it will only be 10% because that franchise has a gym school, and they're going to be able to teach you and support you into your success.
Right.
So a minimum of 10%, it could go 20 and even 30%, depending on the industry, where it is, the stage, your experience, and the lender making that decision.
Of course.
So I've done assisted living facility startups at 10%. I've done them at 15, and I've done them at 20.
Okay. Now, when does collateral come into play? And I'm talking about real estate equity. Is that a requirement on every single loan? Are you going to take my house and home if I don't pay the loan? What's going on there?
So number one, nobody can take your home. The United States government protects you for that, especially if you're homesteaded. So nobody wants to take your home. So when we finance commercial real estate, we will have a first lien on that commercial real estate. That's normal, whether you're financing a house or a commercial building.
Sure.
When you're doing a startup and there's no commercial real estate and there's what they call a lack of collateral, we follow the SBA guidelines. So I cannot decline a loan based on the lack of collateral. It is one of the C's of credit that we look at, but I cannot decline you solely on not having collateral. But if you do have personal collateral with equity in it. Now, so let's talk about equity. I wish I had like a little whiteboard for you, but if you owned a home with it was valued at $100,000, we're going to discount the collateral. The reason is in a fire sale, if we took that home, if we had to take possession of the home and resell it, we wouldn't be able to sell it for $100,000. Right. We would probably sell it for 85%. So $85,000. So when we assess collateral value, we look at what they call a discount rate, which is 85%. So let's say you have that home, $100,000, and you have an $85,000 mortgage, meaning that there is no available collateral. We would not take a lien. But let's say you own that $100,000 home, which we're going to give the $85,000 credit, but you have a $50,000 loan. So the gap in there between the 50 and the 85, we would take a lien on that per the SBA guidelines. I don't have an option. It is what's required for it's required for any and every property that has available equity until we fully secure the loan.
And is that on any loan size? Does it matter? Or is there a circumstance where that's not required?
When you get into the express loan, the smaller loans, they do not require it. It is the lender's. It's up to the lender's prudence as to whether or not they wish to require it or not.
And do you know, to be clear, what is that considered, an express loan, smaller loan?
So the express loan verbiage went away and it's now called an SBA small loan, which is under 500. And I'll be really honest, I don't do loans under that are smaller. So I'm not sure if that guideline stuck at 350 or if it moved up to 500. The
Okay.
last I was aware it was 350 and under did not
Mm.
require it. I don't know if it moved to 500 or not.
That's okay. Yeah. I clarify that with each bank that I work with. And I also know that it's on a bank to bank basis because on a smaller loan, one bank may still require it and another bank may say it's okay. And it could be on a case by case basis as well. So,
It can totally be case by case. Again, the SBA it makes the minimum requirements.
mhm.
The lender always go and become a little bit more stringent.
So now our max loan on the 7A is still 5 million, correct?
Yes, it is. I know.
And how about on a commercial? Is it capped at 5 million as well
Commercial.
for property, commercial
You mean
property?
a 504 loan or a
Correct.
commercial?
For
Oh,
five.
a 504 loan. So when you look at a 504 loan, it's a what they call a debenture loan program. So it's a participation loan. So the bank does a first mortgage and then the SBA comes in and debentures the second mortgage. The second mortgage at a maximum is 40%, depending on the property and stage of the company. That second loan can be 5 million. So on average, you can go up to about $18 million purely on commercial real estate that's owner occupied.
One more time, how much?
Uh, about 18 mil.
About 18 mil. Okay. And again, you said that could be stretched out over 25 years.
Those funds are stretched out over 25 years, unless it's heavy equipment.
Mhm.
So the 504 does not do rolling stock. It would only do like large equipment, MRI machines, life equipment that has a lifespan over 10 years.
Okay.
So at that juncture, if it's a lifespan of 10-year equipment, the loan would be 10 years.
Okay. This is great stuff.
Manufacturing equipment. I mean, I'm talking big
Right.
equipment.
Right. So let's talk a little bit about that now. As far as equipment is concerned, manufacturing equipment, big equipment. When does it make sense to finance equipment? Using the SBA loan, and when does it not? Like, I know that in certain cases, like for folks that are looking to buy a truck, for example, it might not be the best thing to do. But like you said, if the lifespan of the equipment is at least 10 years, then it makes sense. Can we explain to the audience why? What's the difference there?
So a vehicle doesn't typically have the lifespan of 10 years,
Right.
number one. Number two, it's on the road, so it's constantly moving. So when we take a lien on that property, if that vehicle gets in an accident, you have to come to the bank. We have to go to the SBA, release the collateral. It takes weeks. It's not, we're not a consumer lender. We're dealing with a government guaranteed loan program. So most lenders, not all, will not typically touch the vehicle aspect. I have done quite a few vehicles in my time. I've financed an ice cream truck route. I've done a plumbing company with a bunch of trucks on the road, AC companies. I've even done Federal Express routes where there's P&D and or line delivery trucks going out on a consistent basis. Like I said, again, it is eligible under the SBA 7A loan, but not every lender does it. Um, what most lenders love is the large equipment, the radiology equipment, the MRI equipment, manufacturing pieces that have to be installed, um, that kind of stuff. Bigger trucks, meaning like tree trucks, bucket trucks. And again, it's all per the lender's discretion, whether or not that's the type of loan they want to make or not, but it is eligible. When you get that, I've done MRI and radiation equipment on a 504 loan. It was a lot of money. And they chose to do this because it was a lower down payment than going through the vendor themselves. So every deal has to be looked at as to how it fits best into the business owner's business plan,
Mhm.
and then whether or not the lender has an interest in making that type of loan.
Now, I'm looking at this land over here. This land is, I want to buy land. I want to build, a building on it. and I want to occupy that for my business. Um, is that something I can do through an SBA loan?
And we love construction loans. I have a personal um, love for construction. Not everybody does. You can, but construction comes with its own quirky requirements by the SBA, timing, etc. Because I can't finance just the land for you to develop 5 years from then. If you're going to try to do that, you're going to have to get a bridge loan, and we can take the bridge loan out after you get your plans and specs and we're ready to do the construction loan. Because SBA doesn't allow us just to do pure land unless that land is being utilized by the company. For instance, if you're going to do truck storage in the land is just land and it's only going to be used for some kind of storage, then we could purchase it, put a fence around it, etc., as long as it's zoned correctly.
Oh
But when
wow.
you get into when you're getting into raw land, you're getting into a lot of different integral pieces such as zoning, permitting, um, what's the true construction cost, how long will it take? There's a lot of different aspects. It's a whole nother discussion.
So I could actually purchase the land, as a lot to park my trucks, my vehicles. How about if I was a car dealership? Just bring that up, and I needed a lot for the vehicles, for the cars. I'm not going to build anything on there, just the lot. Is that going to be sufficient, or does there have to be some building on the property at all?
You do not have to have a building on the property, although car dealerships usually have an office of some
Sure.
sort. Usually it would be more storage. I've done land for a lawn maintenance company,
Hmm.
and we just put up a big fence and a gate. So that kind of storage, you can do that.
So going back to construction now, do I get to pick the construction company, or does the bank control that? And, does the bank have to approve the construction company that I select? And do I need to come to the loan with my construction plans, or when do I have to present that, to be able to close the loan or to even get a letter of intent? Or, well, how does that look? What's that about?
Construction's a whole nother animal. When you're dealing with a construction loan, A, you're going to have to find a piece of property. B, you have to make sure, is it zoned properly? Will it be able to be zoned properly? Zoning in some areas can take as much as 6 and 9 months. I cannot close a loan until I know that the zoning is appropriate. Um, Typically, the best way to know it, to understand it, is we close when the permits are ready and the contractor's ready to build. So when you're doing a construction loan, the borrower themselves are going to have quite deep pockets, because they're going to have to provide the plans and specs from the architect. They're going to have to get a hard quote from their contractor. They choose the contractor. We don't choose the contractor. We will review the contractor, but there's certain aspects that the contractor must follow in order to be eligible for funding through construction. Those items are fund management, um, and what they call retainage, meaning we don't pay 100% every time it's being drawn down. We hold back our retainage to ensure that the project in itself is fully completed. So it's quite a lot of information to dive into, and we can
Yeah.
always go step by step.
Okay. Okay. And is that applied to leasehold improvements if I'm not buying the property, but I just want to improve a lease that I'm committing to?
It is.
Yeah.
It also applies. So any construction project over $150,000 is going to require funds management
Hmm.
by the bank in accordance with the SBA regulations. Which what that means is that you're going to provide your plans and specs. We're going to require an AIA, American Institute of Architects contract between you and a contractor. Um, that would typically, if it's a landlord situation, they're going to have to approve the improvements as well. We're going to take those. We're going to have those fully reviewed to make sure that the project is a complete project. And also in that, the contractor is going to supply us with all their information, meaning their GC license, their financials, their past projects, what their balance sheet looks like, to make sure that they can manage the project. The whole project will be ran through AIA forms. Um, and then After that, once it's all approved, that's when we move towards funding. When you're looking at approving a construction loan, we start with guesstimates and we typically increase those guesstimates a little bit because we fund these all day long. And for instance, now in 2024, I have people calling me saying, oh, it's going to be 175 a square foot. I haven't seen anything under $300 a square foot since COVID. So typically not everybody is in the know of what construction is actually costing these days.
Yeah.
So we're going to pre-screen your loan based on your projections and an inflated expense for construction. If it works, then I'm going to send the borrower on their way to start with the architect and the engineer and the permitting and not the permitting, the zoning to make sure that that can come in. But I can't actually underwrite a deal until I have the final contract quote because I don't know how much it's going to cost.
Thank you. All right. So now I'd like to just take a step back to talk about your existing businesses, some of the requirements, and then I'd love to get into something that I know you're extremely passionate about, which is the commercial real estate. And so we talked about the kind of some of the startup requirements as far as the equity injection and the post-closing liquidity requirements. Now, for an existing business, now we're talking about 2 years or more, right? I know we're looking for at least 2 years tax returns, obviously, right? Just talk to me a little bit about the potential requirements for the equity injection, because I've had people tell me, oh, no, I got an SBA loan and I only paid, and then I'm not going to even say, but ridiculously low deposit, down payment requirements. Is it the same? Can an existing business have a much lower equity injection requirement? And, if you could just speak to some of those requirements for your existing businesses.
Yeah, it depends on what the client's going to be doing. I had a IT company that bought another IT company. The borrower had already been in business for 5 years. So he had a really good balance sheet. Therefore, we did it with as little as like 3% down
Mm-hmm.
because he had that strength and the company he was buying was just going to add to the strength. So a lot of that is based on per deal scenario, looking at the financials and the credit strength, the liquidity strength, the cash flow strength. So there's always an existing. If you're just going to grow by your own fruition, they might want a little bit more down. It just depends on the scenario, what the industry is, what they're trying to do. If you have one restaurant that's been open 2 years and you're just starting to show cash flow and you're trying to buy another one, they might want 10% down. They might not. It just depends on the financial situation.
Okay.
Um,
Can it be
so
less
it
than
depends on what
10%?
you're using it for. What's that?
Can it be less than 10%?
Yes, it can.
Yeah. Okay. So just to kind of, just to say it out loud for the audience, and correct me if I'm wrong, or add to this list. Typically what I'm telling folks is they need to bring, 2 years tax returns, year-to-date profit and loss statements and balance sheets, and a debt schedule, personal financial statement, personal credit, and then their business credit, which is the SBSS score. When does that come into play? Does that matter at all?
That comes into play on the smaller loans.
Okay.
On the larger loans, we're going to do a business credit search.
Okay. So you're looking at do you know what bureau? Dun and Bradstreet, Experian, Equifax?
It depends on the lender. Some lenders use a clear report, some use Dun, some use everybody uses. I even know one that uses TransUnion. So
Okay.
it's a million different aspects. Every lender chooses their vendors.
So having a clean business credit profile with a little depth and history, and of course we want to make sure that you don't have any UCC filings, correct?
Yes, and don't forget, anytime you do an SBA loan, we run a Keevers report, which is becoming very, very integral at this time.
What is it
Due to
again? Dee? Just repeat it.
It's called the Cavers
Caver.
Cavers report. What that does, that report shows whether or not the borrower and or the guarantors do not have any due payments to the IRS or the United States government. So if you had an EIDL loan that's currently not being paid, even if it's on an affiliate company, I cannot lend to you. You have to be in good standing with both the IRS and the United States government in order to apply and obtain an SBA loan.
What's an affiliate company?
An affiliate company is another company you own. So let's say you have a chicken salad chick and you have another chicken salad chick and another, and you're doing a third. All those three, those are now affiliates.
Gotcha. Does it matter how much percentage ownership I am in any of those affiliates? Is there
Household percent is 20% or greater, and it's
20%?
considered an
Okay.
household.
Mhm.
So if you own 10% and your wife owns 10%, your household is 20%.
How about if my wife owns 30% and I own nothing?
Still household.
Wow. Okay.
If it's in the same industry.
Got it. Okay. Got it. In the same industry.
If it's in a different industry, it may not fall under the affiliation rule, which just changed.
If it was in her name, my wife in this example, but how about
Still in household.
right?
If your wife owns it and you work there, it would still be considered an affiliate
Understand.
if you're buying something or doing something in the same industry.
Now, if I'm an owner of a business in a completely different industry myself, and I'm opening up a new business, then that's still an affiliate because I am the direct owner.
Correct.
But
We're
if
going to look at it.
Mhm.
It's prudent to look at that
Right,
business to make sure that it's in good standing
certainly,
and make sure that it's cash flowing its own debt and it's not drowning.
right.
That's just prudent lending. Besides, outside of SBA, it just makes sense.
Yeah. Now I know. I mean, for me and you, there's some things that are probably obvious, but for the audience, I just want to like nip it in the butt. We can't accept, unfortunately, if you've had a bankruptcy in the last 2 to 3 years, 7 years. What are we looking at here?
Most lenders want to see 7-year clear of BK.
7 year clear BK. How about any kind of defaults like collections, charge offs, things like this on their personal credit?
So even on the BK, there's always exceptions. It's why did you file bankruptcy? Was there a family tragedy? And you can get around it in certain instances because there was a horrible situation. Um, we're just talking about the hurricanes. We're going to be seeing this for years and years and years to come. What it's done to people's personal, you know, their homes and what's going to happen there. So we will see this for years. I remember back in Hurricane Harvey that hit Texas, and you get tax returns stamped with the word Harvey all the way across it. And you make certain understanding, exceptions for those individuals. But for the most part, we want to see free and clear. Individuals get bad credit for different reasons.
Yeah.
Every lender is a little bit different. Some are like 700 above, some 680. I'm currently at 650. But if the collections are old, I would just get a letter of explanation and move on. If they were in the past year, I'm going to really need to understand, and it might be cause for me to pull away from the deal and approving the deal if they had bad credit.
Right. I completely understand that. So, okay. Along the lines of debt, um, can someone use an SBA loan to restructure bad business debt?
Yes.
They
In
can.
fact, we've worked on that before, haven't we?
Oh, okay.
So a lot of people end up with loans that they had to get that loan in order to meet their immediate needs. As long as the debt is in the business company name,
Hmm.
so we're not refinancing personal debt. That goes back to accounting 101, which is separating your business from your personal accounts. Um, and we can show that we're going to save a minimum of a 10% cash flow, or the loan is unfavorable, meaning it's ballooning. We can consider that as a debt refi. And it can be working capital debt was done, equipment debt, commercial real estate debt, whatever it is, as long as it's in the company name and it can cash flow.
Okay. So I know that one of the challenges with certain debts is, especially for example, MCA debt, that it's a moving target that is constantly being updated, sometimes daily or weekly. And so that could be a little bit challenging. But it is still something we can help people get out of and get into more favorable circumstances. And one of the other variables is the UCC filings with those debts, right? And so they have to make sure they have cleared all their UCC filings, and ultimately before the loan can close, even on the debt that's being restructured, that has to be coordinated. So I just wanted to kind of bring that up and have you kind of either put your stamp of approval on that statement, or if you want to add to that.
No, you're 100% correct. When business owners get involved with a lot of MCA debt, they end up getting one, paying it off, getting another one, paying it off, getting another one, paying it off. Before you know it, they've had 6 or 7 of them. I'm now trying to refinance their existing 4. And while I'm in the process, I always tell them, go to your attorney, do a lien search on yourself, and make sure the ones you paid off have actually filed release of lien. Because when the SBA does a loan like that, we are going to take a first UCC. We're not going to close without it. Therefore, if you've got some dangling UCCs sitting out there for stuff you paid, it's the borrower's responsibility to make sure they're cleared. We're not going to do that for you. That would be your job, your attorney, your consultants, your CPA to help you get all that cleared so that when we get the payoffs, we pay off the existing 4 or 5 loans and we're in first place. And although it is a moving target, it can be difficult. What we typically do is we'll schedule to repay them. The loan process is going to take about 45 days. And then anything that you might have already paid off from when we submitted the loan process, it is either lowers the loan or it can potentially be returned back to the borrower in the form of working.
Got it. Okay. Um, so one of the questions I get often is, and it's from 3 groups: women, military, and minorities. What's considered minorities. Um, is there some type of special program or discount, or what's the incentive for me as a woman or as a minority or as a military veteran, to for with the SBA loan? Isn't there a special program right now for me to be able to get this loan?
Currently, right now, there are no special programs. You have to keep an eye out on SBA.gov in order to figure out anything that's new. For military, I always say thank you very much for your service and keeping our country a free enterprise. For women, I am all behind you. But the majority of these individuals, they get to check a box. They check the box for the statistics to be run out of the United States Small Business Government, SBA, Small Business Administration, in order to say we made this many military loans, etc. Some lenders may run certain different programs for veterans, whether it's a marketing tool or it's truly a benefit. Not all of them give a benefit. Back in, and I don't want to go on record with the date, earlier 2000s, they did have a veterans program that for about 3 years paid for the guarantee fee
Hmm.
for all veterans, but that's well expired, probably at least 8 years to go. Haven't seen it since, but I love veterans. I've done veteran loans. I know other people that do nothing but veterans loans. And the reason they get into that is because some franchises focus solely on veterans.
Hmm.
Um, they work with certain franchises that only, service that locally here on the Tampa Bay market. Um, Raining Berries is a franchise that primarily works with veterans and veterans of the police force, etc. And so, if you're doing loans for Raining Berries, you're doing a lot of veteran loans.
Right.
But there's no free. I don't know of any grants in the United States of America that gives money away.
Yeah. So thank you for that, clarifying that. And unfortunately, no, folks, that there are no programs right now. Like Denise said, we have to keep our eyes out, and we would love to be able to say yes to that. But right now, everyone's kind of in the same playing field. Um, the same variables apply for underwriting to everybody. So that is just what it is. Um, so with that said, Dee, let's transition into your passion. That there's a little pin there on your blouse, CCIM. Can you tell us about what that is, and elaborate on, just your passion, which is the commercial side of the business?
Yeah, so commercial CCIM designation. It's a global designation. It's the certificate certificate of commercial investment management. I always say that it's like having a master's degree in commercial real estate for investment. So I earned this designation a few years back. I love commercial real estate. Just the large, it's not necessarily the larger aspect of it. I love the land. I love real estate. I like construction. Some people think I'm crazy, but I really do enjoy it. It's a lot of numbers, parts, dealing with contingency cost overruns. But I love it. I love looking at properties all over the country and helping individuals occupy them and growing their businesses a lot bigger than, just all the smaller individuals. It also allows me to look at leases a little bit closer. So I've looked at a lot of leases, the difference between base rent, percent rent, what the cans are, et cetera. So trying to help my owners, my borrowers understand what they're getting into when they look at a purchase contract and a lease, and being educational to them.
Now, is it more likely or more beneficial for someone to consider commercial property as a startup, or as they've grown and they're ready to expand, or maybe is it wiser to start with a lease and then transition to ownership, or should you consider starting out with the commercial property acquisition?
It all depends on the industry because obviously, if you're going to do a hotel, you're going to buy real estate.
Right.
If you're going to do an assisted living facility, you typically don't rent it. You're going to actually buy the real estate. If you're doing a doggy daycare, it depends on the market in which you're trying to enter. Is there real estate or do you need to lease? So every industry sort of has their own. Typical small businesses will start in a lease and um, move to acquiring real estate. But at the same time, if you're a franchise restaurant, you may only lease. You may never buy a piece of real estate. It just depends on what it is because like so Chicken Salad Chick has two different models. You could not do a drive through or you can do a drive through. If you're just doing the strip center, you're only going to lease, you're not going to buy. But some chicken salad chicks are now buying the real estate and investing in the real estate aspect of it. And they're putting in a drive through and they're becoming those out parcels. So it just depends. It's really up to the borrower.
Mhm.
It's also up to their equity injection. If they don't have the money to buy a piece of real estate, obviously they're going to look at leasing. So it, everything is everything's up for grabs. Most of your Primrose daycares and your daycares, a lot of them buy their real estate instead of leasing it.
Now, if I am purchasing a commercial property with an SBA loan, um, I know there's some rules and requirements as far as how much of that property I have to utilize and occupy for my own business. Um, so if you could answer, speak to that, as well as, am I able to lease out or rent out any additional space? Is that allowed, or what are the rules there?
So when you're talking about what we call owner occupancy, which is very clearly defined in the SBA SOP. So in order to become an owner occupied property under an improved property, meaning it's already existing and the business in which I'm funding needs to occupy 51% or greater. They can lease out the other aspect of it. The SBA allows this to happen because of future expansion possibilities. So you can do that. When we're cash flowing, we're not going to take into account the lease. We're only going to take into account the owner who's occupying the space. So they need to be able to cash flow the whole deal. Now,
Oh,
when you're doing a construction project, meaning a ground up construction, that occupancy increases to 60%. And when you have a building, whether it's the 51 or 60% that has other space, I, as the lender, am not allowed to build that out because it's not for my borrower. So if you're going to buy a building and you're only going to use 58% of it and you're going to lease the other portion to another doctor, the doctor would have to build out that space. I cannot absorb that into our loan.
I understand. So what am I supposed to do if I'm looking to buy, let's just say an office center? You know, I can't use an SBA loan to buy an office center unless, no, it doesn't apply for that purpose. Yeah.
No, most of your smaller businesses look at buying, they'll buy office condos. So it's like one unit in a strip of different ones or half of a building. An office condo is it's a destination of ownership. So you own the building, but maybe not all the land. Sometimes you do, sometimes you do not. Um, Otherwise, you find an out parcel building that you want to be able to buy. And I've actually done a loan where two individuals bought one building. So they created a company, which we refer to. It's an EPC, the passive holding company for real estate. And one doctor was going to occupy 50%, and the other doctor was going to occupy 50%. And they bought one company to do the building. So I financed the building, and then both individuals were on the loan as well.
Oh, okay. Very interesting. Do you currently have any or previous cases besides this one, that you're working on that you can tell us a little story about, or any just a vision setting that you can help the audience to cast as far as what they can do and how you can help them in the commercial real estate space?
On construction, there's so many stories, it's insane. So, one I love that I did a couple years ago, thank goodness they survived the storm. I supported a couple who wanted to own an assisted living facility, did not want to necessarily buy a 20-bed facility. They wanted something smaller. So they purchased a duplex.
Hmm.
They broke down the walls in between. They had it rezoned, and they put in a 10-bed assisted living facility with one kitchen into Southwest Florida. It's a wonderful couple, and they're doing great things in their community. It was a lot of work. I'm not going to lie. I warned them it was going to be a lot of work. But going through all the aspects that you deal with in ALF, the generator, the fire suppression system, having the correct doors, getting the licensing, working with ACA, who derives how much square footage per bed needs to be there, going through all that process. But it's a beautiful project. They're, reaching great success, and almost full right now. So, but when you deal with construction, there's always little hiccups and things that you learn, whether it's getting the fire code approval or, final CO to be able to open your doors. Another project I'm going to the grand opening in a couple weeks it was a lease space. It was a prayer gym on one side, and another space was a dance school. And we've gutted that and turned that into a doggy daycare and boarding, grooming, and put in a splash pad.
Oh,
And that's all lease space.
oh wow.
So it's not even owned. It's just in a strip center.
Hmm.
But it's going to be a great addition to the area. There is not a facility like this in nowhere. In the whole community, there's nothing like this. Everybody takes their dogs 20 minutes away. So really happy to be able to work with them. And again, the architecture process took about 5 months. Then the bidding for the contractor took, another probably about 5 weeks. Then we started our process because I couldn't start it without knowing how much it was going to cost.
Right.
So fun stuff.
Awesome. Awesome. Well, I'm going to go ahead and ask you to just speak to the audience one on one. I'm going to give you the full camera. Just anything you want to share from your heart regarding the loan process, regarding just business, regarding life, anything that you want to convey of value. Please, the floor is yours. There you go.
Awesome. Well, hey, thank you for watching. Sebastian's a great person, a great friend. I'm always appreciative of him inviting me on. If I would give any advice, I would say number one, anytime you're working with a loan officer, realize that we're on the same side. I am not here to naysay you or anything. A good lender is here to help educate you, walk you through. I always say I'm the mom of the deal. My goal is to help every individual be successful and to reach their dreams. And my goal is to fund it into reality. Read, invest in yourself. Anything you submit it with passion. show who you truly are there, and never be afraid of asking for help. Whether if you think it's a silly question, it's not a silly question. It's a good question. If you're not prepared to do the business plan, don't be afraid to ask for somebody that might be able to assist you and work with you and consult with you to get better. A business owner is only as good as their full tool belt. I want to be one of those tools, and you're going to need to fill it up with all the other tools as well. Sebastian's one, your CPA, your attorney, a marketing individual. Don't try to do it all on your own. That makes one tired individual. Make sure that you've rested and you're able to turn your passion into reality by leaning all other individuals and being able to shine.
Thank you, Dave. I appreciate your time. Thank you so much for all of your knowledge, all of this information. I hope the audience sees the value in your experience and your wisdom. And, you're really a blessing as a friend and as a business associate. So folks, there'll be a link in the description below if you want to reach out to Denise directly or to me directly, one or the other. Either way, I'll get you connected to Denise. It's probably wiser to come through me so I can filter and make sure you're the right fit for Denise. Because I do work with a lot of different banks. Denise has a minimum loan amount that she works with certain industries. So I just want to make sure before we, flood her with phone calls and emails that you are the right fit. Allow me to filter that for you. I'll get you over to her if you are. And Denise will help you, and I'll assist you as well in packaging your loan and getting to the finish line, because that's ultimately what we want to do. Right, Dee?
That's just the guy. He will help get you prepared so that when you're put on my desk, this goes fast and smooth. He is the man who will get you prepared for funding.
All right. Well, thank you so much. Hang tight. I'll be right with you. Let me just close out.
Okay.
Guys, again, thank you so much for watching. I hope this video was of value to you. Please make sure you like, subscribe, and share. Let YouTube's algorithm know that this video is of value. Tell somebody who's going to tell somebody who's going to tell somebody about this content, so more people can learn about their opportunity to access SBA loans, including the SBA 7A and the 504 loan. Again, this is Sebastien Boyer, the approved guy. God bless you. Take great care.